Let's kick things off then. People are now coming in. I'm sure they get notified all over the place. So I'm going to give a second for everyone to just get onto their TradingView account or wherever they're watching. And we're going to talk about US indexes to start and some other things as well. Because of course today is NFP Friday. You've also got average hourly earnings month on month for October, average hourly earnings year on year for October, non-farm payrolls for October. You've also got Canada average hourly wages year on year October, net change in employment for October, participation rate for October, and the unemployment rate. Probably the most important thing on there for Canada. Later on, you've actually got ISM services and PMI. Okay, so for October. So it's really, really important to understand that news, whether it be your Institute for Supply Management Services, Purchasing Managers Index, or it's non-farm payrolls, everything feeds in a similar way. It gives you that view of the global economy at this current point. So if you're coming in, don't forget to press the like, get my free training underneath, and I'm going to go ahead and start off. So people have asked me about all kinds of US indexes. So I've got three up here. I've got the US100 NASDAQ, I've got the US30 Dow Jones, and I've got the S&P E-mini futures in the center. And if you look at the picture for all of them, okay, you can see that what you've got is clearly the same trajectory, more or less. It's a downtrend. It started in the summer, in July, and it's continued thus far. Okay, and that's really as people consider whether there is a soft landing within the US economy. Okay, it's a very debatable subject. Your S&P particularly and your Dow Jones have shown much more of the steeper fall, okay, the steeper downtrend, compared to your S&P. And what's happening with the Dow Jones, the S&P, and the US100 NASDAQ is that they've had a significant rally. Okay, there's loads of people coming in. Don't forget to press the boost. I will just say again, the boost button is there on the left, or it's up top on the right if you're watching on your phone. Don't forget to press it. And my free training is underneath for all those who are brand new. Continuing on from what I was saying, pretty much in short, I would say that your US indexes are at a really significant point. Now, this morning I just shorted various indexes myself, the FTSE, the CAC, the ORS, and mainly the indexes I trade. But the rally across the board on all these indexes comes off the back of the fall, which was sustained, when you started to have those geopolitical issues. And essentially what it is it's cooling down or a rebound from that. So the picture really is the same across the board because all indexes are affected similarly, okay? And they look similar because they're in the same economic zone, being the US. So I think mostly what people are wondering is, what is my opinion on this? Well, with the NFP news coming, unemployment rate in the USA, services employment index, and ISM services and whatnot. It all feeds in, like I said, to market sentiment. But at this point, you can clearly see, okay, and we trade with reason and fact, but you can clearly see you've had a significant downtrend on charts like your daily for a significant period of time now. Okay, and you can see that on your US100. You can see that a lot more steeper. That's the wrong tool. See it a lot more steeper on this S&P. Really, really sharp fall there since the summer and a similar date in July. And then again with your Dow Jones, you've got a very similar picture as well. Now, I would imagine where my camera is on the left is blocking the US100 for now. So I'm going to just open it up wider for a moment and get down to the nitty gritty. So you can see at this point what has happened has been that we bounced near enough off that 200 MA. Okay, for it looked like this, right? And it doesn't anymore because you've had a lower low. So you could in fact just take the last low there. That's a little bit more accurate, right? Using the second low and the second high about to be the third. So if you look previously, you had a similar thing, a series of green up candles within that downtrend after a significant fall from the highs. So the reason why we're trading trends is because trends rule the market. They're the natural formation that markets take by fact. And it's not just trading where you see trends, is it? You see trends in people, you see trends in other industries, car industries, stuff like that. So markets trend. It doesn't really matter what you're trading. Now, just above where we are, there's a few levels of key price action or rejection that may form the basis for further shorts. Along with that, you've got your higher 200 MA and your stock oscillators coming way up. So really from a technical perspective, it very much appears that you're coming to where I would much rather have it short than be buying. Just with a mixture of these technical factors, you're really just putting up the probability of success. You've got your downtrend, you've got your key moving averages arriving, you're crashing into price action zones. So my bias really for your US 100 comes short slightly higher. I have shorted other indexes slightly earlier than I probably would have liked, but overall I'm getting short value on them anyway. And it's not like I'm looking for, like as accurate entry as I can, but I know if I short around short value areas, then I am going to get that. So within this downtrend, this newfound downtrend, I would expect a move from there, and that's why my short bias comes there. It's really a technical basis. Now, if it comes that the news today, employment data does that for me, it would be great. Probably better if you can just spike up really quickly and then be rejected away and down, okay, something like that. And I would look for exits around early support, okay, probably near 14,750, 14,8. So a little bump up and then down. I would expect ultimately if this does continue, then you'll get under this low, just like you have every single other time previously. But I'm not holding for that whole move. I do swing trade indexes, but I reflect on higher time frames like your daily and your weekly and your monthly mostly. And if I just swap to the other charts I had, and I zoom into them a little bit, where are we? Right, so the SPX, oh, it's 2, don't want that, definitely don't want 3, as you can imagine. So you can see, again, your S&P, very similar to your NASDAQ, you're coming to very key levels of resistance. You can see that on the left-hand side, and we want to put the probability of success up. Okay, so we're going to trade in line with the market. That's why we're looking for a downtrend, because the market's downtrending naturally. We want to ride the wave, okay? You don't want to swim against the tide. Going with it is far easier. And you've got your key moving average there as well. So there's a mixture of tech values and indicators. Wouldn't surprise me either if your stock oscillator comes up. Now, technical analysis is nothing without risk management. So don't try it at home if you don't have risk plans. Of course, if you want those, go underneath this video. The link there for free is right there. If you want to take it further and you're a serious trader, of course, you can get in touch with me via that same link. So we're going to now talk about the other index, but just to be clear, if you're going to short the S&P, I would rather do it slightly higher, probably looking for an exit much further down. Okay, you may find your stock oscillator looks a bit like that, or your RSI. Okay, whether that happens today or not with all that US news is yet to be seen. You'll just have to wait. It is always more convenient if the news can do things a lot quicker. That's definitely true. But nonetheless, like I said, if it takes time, then it takes time. There is no ETA in the markets, and there is absolutely no rushing the market either. Your goal is just to identify that short side value. I mean, you've already seen day after day of up move, a massive rebound. Tensions really haven't gone away. And it doesn't look particularly like this candle, which you can see right here, is holding strength anyway. Really doesn't look strong to me. Doesn't look like you're having a high push up. Therefore, my short bias remains quite clearly. If I go to your Dow Jones, similarly, you've got the same thing. Okay, you've got this persistent downtrend, right? and it's come down and down and down and down. You did have this high, and this is where breakout traders will get destroyed because they think this is a long. Okay, it's not. It's not a time to buy. It may be the case that you have to adjust your trend lines and your parallel channel. Okay, you'll only really know how to draw one of these if you've got concrete rules, but it may end up looking something like that, or perhaps something like this. Okay, I can see slightly better levels of price action and rejection higher up in line where you've previously been. It really wouldn't shock me if you reach there, therefore. So really across the board, you're starting to get into areas of short side value. And along with that, you've got a little bit of space until you peak up to key price action areas like this. But mainly, my bias just remains short because you've had a significant pull up, 1, 2, 3, 4, and you'll be on your fifth candle perhaps going into next week. If you check that stochastic oscillator, and this is why, like I said, we use it. It's because often when it is high, it's not every time, it's not every time at all. But you'll find that when it is high, the market falls eventually. Okay, maybe not right away, but eventually. So if you're buying at highs, sometimes the market will keep going, like you may see now. But over the long run, you will find it's not a profitable process to be buying highs because all you're doing is buying in to where the smart money sells or where people who make money sell. Okay, I've shorted today. There'll be many people who are long. The market may rise, but because of my risk plans, I can cope with that. If you don't have risk plans, you find you really cannot cope with that, and it becomes incredibly dangerous. So a move off from 32,000 points to 33,850 is about 1,600. Okay, 5% or so. It's a long way. All right, so just be very careful of that. Now, we'll use this example as well. If it does turn out that the market goes even higher than that, we would really want to be planning DCA entries. Okay, so I'll put my time frames up for this. You can see about where I drew the previous short zone, okay, and where I would like it short, ideally on your Dow Jones. If you get any higher than that, okay, I would probably look for a rejection around here and a short entry nearer 35,000. I would say probably across the board for the rest of your US indexes, it's quite similar. Okay, as the market rises up, you really want to identify where you can DCA short and where you can return into the market and get that market value. If it does turn out that you flop down, I only would sprinkle light entries just in case your downtrend continues. It wouldn't be a shocker if it does. You've got very, very key levels of price rejection. Okay, so just be really careful with that. If you are going to long, and perhaps some of you might feel like scaling in about 33,300, don't be silly. Don't say, oh, I know what's going to happen and I know this and that, because you don't. You never know. I mean, you don't know how low it will go and how quickly it will go. All you can simply do is take market value, and when you get an enormous impulse candle like this one, which we just had for this week, you really want to start to move to the short end of it. Because after moves up, after really, really quick moves up, often you find you have larger and faster impulse falls. So regardless of the US index you're trading, my bias remains short. If it goes higher, then my bias will still remain short and I will short again. And it's the same for all these indexes that I trade. Okay, doesn't matter what it is. People are mixed on their opinion about how the global economy is going to go. If you find that energy prices increase rapidly, which isn't a million miles away, you might find it causes a massive issue and the whole thing about inflation is completely dismissed. So, as always, I very much hope that helps. My bias, to be absolutely clear, on the Dow Jones, your S&P futures, US100 Nasdaq, doesn't matter what you want to call it and what it is, I'm short on all indexes. If it goes even higher, I'll continue to be short. If you're trading today, do not guess the news, do not guess what NFP will do, and make sure you get my free training underneath this video. Make sure you like, share, comment, and subscribe.